Hey everyone, welcome back. I'm Eric, and today we are diving into an absolute classic, William Bernstein's The Four Pillars of Investing. We're going to break down his blueprint for building a portfolio that can actually stand the test of time. Let's get right into it.
But before we jump in, let me ask you something. When you think of a bad investor, who pops into your head? Maybe someone just starting out, or someone getting their hot stock tips from Reddit. Well, the real answer is probably not who you think.
So believe it or not, the author, who's a retired neurologist, by the way, says that the absolute worst investors he ever met were his own colleagues, other doctors. Yeah, we're talking brilliant, highly successful people, but their investment portfolios were often a complete train wreck. So what's going on here?
So here's our game plan for today. We're going to start by figuring out why investing is what Bernstein calls a loser's game. Then we'll get into the core of the book, his 4 pillars for success. After that, we'll get practical and build a simple winning portfolio. And finally, we'll wrap it up with the real secret to long-term success.
Okay, let's kick things off with this really core idea from the book, and it kind of flips the script on how most people think about the market. For most of us regular folks, investing isn't a game you win by being a genius. It's a game you win by just not losing.
And Bernstein has this perfect analogy for it: amateur tennis. You know, when you watch two regular people play tennis, the winner isn't the one hitting incredible, amazing shots. Nope. The winner is usually just the person who makes fewer stupid mistakes. They just keep hitting the ball back over the net, while their opponent keeps hitting it into the net or way out of bounds. Investing, he argues, is exactly the same for us.
So, if we're just trying not to make mistakes, who exactly are we up against in this game? Well, you're basically fighting a war on 2 fronts. You have the external enemy, which is the entire financial industry, and then you have the internal enemy, which honestly is way more dangerous: your own brain. Let's talk about that external enemy first. And look, we got to be real about this. The financial industry is a business. Its #1 goal is not to make you rich, it's to make itself rich by taking fees from you. It's basically a giant casino. The house always wins in the long run because it takes a little slice of every single bet, no matter if you win or lose. And don't let anyone tell you those fees are small. They are absolute portfolio destroyers. A 2% fee might not sound like a big deal, but look at this chart. Over 40 years, 100 grand earning 8% turns into more than $2.1 million. Amazing. But that 2% fee drops your return to 6%, and you end up with just over $1 million. That's less than half. The fee didn't just cost you 2%, it cost you more than half of your entire future nest egg. It's devastating.
Okay, but the external enemy is kind of the easy one to spot. The really dangerous opponent is the one staring back at you in the mirror. Our brains are just not built for modern financial markets. We have these fatal flaws. First, overconfidence. This is the doctor problem. You're a brilliant surgeon, so you think, hey, investing must be easy too. Wrong. Second, the herd mentality, FOMO. Everyone's buying some crypto or meme stock, you feel like you're missing out, so you jump in right at the peak. And third, recency bias. If stocks have gone up for a few years, our brain just assumes they'll go up forever. It's a trap.
All right, so it sounds a bit grim, right? We've got the industry against us, our own brains are trying to sabotage us, so what do? Well, this is where the book really shines. This is Bernstein's 4 pillars, your actual blueprint for how to win this game.
These 4 pillars are theory, history, psychology, and business. And you can think of these like the 4 legs of a super sturdy table. If any one of them is missing or wobbly, the whole thing is going to come crashing down as soon as you put any pressure on it. You need all 4 working together to support your portfolio.
So let's start with Pillar 1, theory. This is basically about how you handle risk. And there are 2 main kinds of risk. To fight the risk of one single company going bankrupt, your weapon is diversification. You know, the classic, don't put all your eggs in one basket. But to fight the risk of the whole market tanking, your weapon is asset allocation, how you balance your aggressive stuff with your defensive stuff.
Next up, Pillar 2, history. And this one is so important for your sanity. History teaches us that huge market crashes like 30, 40, 50% drops, they aren't weird events. They are a totally normal part of the process. But history also shows us that after every single crash, the market has always eventually recovered and gone on to new highs. So that chaos, that volatility, that's not a bug, it's a feature. It's the price you pay to get those great long-term returns.
Pillar 3, psychology, is all about building a defense against, well, yourself. Knowing your brain is flawed is one thing, but you need a system to protect yourself from your own worst instincts. And that system is a simple, written investment plan. Before you invest a single dollar,
You write down your goals, your strategy, and what you're going to do and not do when the market is going crazy. This piece of paper becomes your anchor in an emotional storm.
And finally, Pillar 4, business. This is where we fight back against that external enemy, the financial industry. Since we know their whole game is to get rich off your fees, your most powerful weapon is to just be relentless about cutting your costs. This means you say no thanks to all those expensive, complicated products, and instead you embrace the simplest, most powerful tools out there, low-cost index funds and ETFs.
Okay, so we've got the theory down. Theory, history, psychology, and business. Now for the fun part. Let's actually put this stuff to work and build a portfolio. And you're going to see this is way, way simpler than the finance world wants you to believe.
Honestly, building a really solid portfolio, what people sometimes call a lazy portfolio, is basically just 3 simple steps. That's it. Number 1, figure out your asset allocation. Number 2, pick your simple, low-cost tools. And number 3, execute the plan with discipline. That is the entire game.
First things first, asset allocation. And this, right here, is the single most important decision you're going to make. I love the spear and shield analogy for this. Your stocks are your spear. They're for offense and long-term growth. But they're also risky. Your bonds are your shield. They're for defense, to protect you when the market gets ugly. For someone in their 30s, a 70% spear and 30% shield mix is a pretty common starting point.
So what's the right mix for you? Is it 70-30, 60-40? Well, you've got to ask yourself one really honest question. If you woke up tomorrow and your portfolio was down 40% in a year, could you sleep at night? Or would you be totally freaking out, ready to sell everything? If that thought makes you sick to your stomach, your allocation is too aggressive. You just need a bigger shield. Simple as that.
Okay, step 2, picking your investments. And seriously, this is the easy part. You can forget all that complicated stuff about picking the next hot stock. You can build an amazing, globally diversified portfolio with just 2 simple, low-cost ETFs. For your spear, something like a total world stock ETF gives you a tiny piece of thousands of companies all over the world. For your shield, a total bond market ETF gives you a super stable basket of bonds. It's simple, it's cheap, it's effective.
All right, last step, number 3, execution. The secret here is all about discipline. And the best way to be disciplined? Just automate everything. Set up an automatic transfer from your bank account to your investment account every single month. That forces you to keep buying even when the market is scary. Then, just once a year, you rebalance. If your stocks did great and are now 75% of your portfolio, you sell a little bit and buy some bonds to get back to 70-30. This forces you to sell high and buy low, without any emotion.
And that's pretty much it. That's the whole playbook. We went from the big ideas down to the practical steps. And when you put it all together, the real key to success becomes super clear.
It all comes back to this one quote from Bernstein that just nails the entire philosophy of the book. Successful investing is about discipline and humility, not intellect or skill. It has almost nothing to do with being the smartest person in the room. It's about having the discipline to stick with your simple plan and the humility to admit you can't predict the future.
So I really hope this breakdown of the 4 pillars of investing was useful for you. If you got some value out of it, it would be awesome if you could hit that like button, subscribe, and share it with a friend. And hey, if there's another book or a big idea you want me to tackle next, just let me know in the comments. Thanks for watching, and I'll see you in the next one.